All right. It looks like we have a few more folks jumping in the room, but we do have a hard stop at the top of the hour. So we will go ahead and get started here. A quick note on risk disclosures. Alternative investments are speculative, illiquid, and investors may lose some or all of principal invested. This is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. So welcome to Arrive's Q3 Financial Performance Webinar. Our speakers for today are Ryan Frazier, our CEO and co-founder, Cameron Wu, VP of Investments, Jake P., Head of Operations, and then my name is Korin, and I lead our Investor Relations team. A quick agenda so we are all aligned. Cameron will be walking through our Q3 2025 highlights, performance for our individual properties, and fund investments. And then Jake will be walking through dividends, Arrive valuation, and then Ryan will be walking through what is new and happened this last quarter. And then for folks that are new here, we will jump into Q&A. So feel free to drop any and all questions in the chat. Primarily, topics for today will be related to performance with our quarterly financials. If you have more intro questions about Arrived, we host those during our Tuesday, Friday webinars and would love to have you there. Without further ado, I'd love to welcome Cameron up to the stage.
All right. Thanks, Korin. Thank you, everybody, for joining us today. Looking forward to go through our Q3 results with you. Oh, okay. Here we go. So we always like to start off with this slide with a very high-level metrics about our property portfolios and the investments that you, the investors, have funded across the platform. So we've had over 500 properties fund, with 56 of them being in the SFR fund. So the remainder being individual offerings that are between long-term rentals and vacation rentals. We have over 300 million invested on the platform. So really a great milestone, and it's been a roller coaster of an adventure. So, thank you for all of the investment and kind of your trust. And then over 100 completed loans. I mean, that's crazy to think about. We launched this private credit fund back in May of 2024. So it's really only been operational for about 17 months now. We've purchased over 200 and have about 100 had paid back. So really happy with the credit performance, which I'll go into in a minute. Yeah, this next one slide, it just shows the asset distribution between properties and loans. And, you can imagine that each successive quarter, this map gets filled out a little bit more and more, especially as we have different investment offerings and different strategies for different asset classes. They work for different parts of the country. For example, we've been asked a lot about multifamily, both large and small. And that tends to be a little bit more of a coastal equity investment, but you can also see that we have many loans that support a lot of the coastal markets in development. And so we just have different strategies for different types of vehicles. But I think this map does a nice job illustrating really the spread of diversification that we're getting, both through asset offerings and what our different investment thesis is. So let's go through some single family residential results for both individual properties and the fund. So our SFR, single family residential rental operational performance, we had 92.5% stabilized occupancy at the end of Q3. And this is, it was a bit of a dip from Q2, but it's also expected. And some of the reasons why is that we really structure our rent roll management to be capturing the better part of the leasing season. So a lot of our move outs will happen in March, April, May. So occupancy declines into the hot season, but we actually want that to happen in the sense that as you get replacement tenants, you're now leasing in the best part of the year. But what it does is that the average occupancy for that period will decline because you're taking the vacates. But the promise of it is that you're renting them back up with better rental rates that are capturing kind of the apex of when rents are the highest, because rentals are quite a seasonal asset. So we had 110 new leases start in Q3. This includes renewals. So, it's you could think about it roughly half with new leases and then renewals. 18.7 months as the average lease term. Again, we stagger most of our leases between 17 to 24 months. So the average lease term executed in that quarter is really a function of where are we in the leasing cycle, what time of year is it? Because we do try to stack all of our expirations in that most advantageous time. Really, over the past 3 years, we've been pulling that forward more and more. First, we didn't really have a a direct strategy to say, all right, let's concentrate all of our leases. It was kind of smooth based on just natural leasing activity. Then we said, let's start stacking our leases to get better expirations. So they started going towards June. Then we said, we should pull it forward even more. Then we pulled it forward to April, and now we're pulling it even forward even more to the January, February time. So this is all a very intentional part of our strategy to kind of catch the peaks and amplitudes of the seasonality curve that we're looking for. But it's a core part of how we manage long-term rentals. Next on the SFR fund operational performance, this thing's been performing like a champ. I've been very happy with how the fund has been performing as far as occupancy, rental collection. 97.9% average occupancy on a materially sized portfolio is definitely outperforming average occupancy rates across the country. And really, it's kind of oscillated between 96 to 100% for the majority of its life. So as far as the income being produced within the SFR fund, been very happy with the dividends paying out and sustaining at around 4%. So we expect that performance to continue, but SFR fund continues to be, from our opinion, one of the best ways to get into a diversified batch of single-family rental properties that really represents the core of our investment thesis of what we've deployed across the country. But you can get it in that nice bite-sized chunk of as low as $100 to get that type of exposure. On the Seattle City Fund, so it's shown some exciting traction lately. We got all 3 properties leased out in the Seattle City Fund, so we're now sitting at 100% stabilized occupancy. So we've got paying tenants in all of them now on those long-term leases. Average rent is somewhere close to $4,000 across those 3 properties. We've also added a few credit investments to that Seattle City Fund. So kind of true to the name, it's a true fund that is oriented around the city across its residential assets. And it doesn't just mean rental homes, it also means credit that is tied to properties in the greater Seattle area. And we're also evaluating some strategic multifamily partnerships that could potentially also be part of the Seattle City Fund. So a lot of permutations there, but the City Fund, we're excited about not only the occupancy there, but also the layering in of assets that represent more of the strategy around the area as opposed to just purely an asset class play. All right, let's talk about some vacation rentals. So we continue to improve performance on the vacation rentals. The cash flow is getting better and better. It is a very seasonal business, much like long-term rentals, but even more so. So you can imagine that beach markets, as an example, would do really well in the summer, but struggle in the fall and winter. And then the opposite is true for mountain markets where, summertime, spring, they can have their seasonal curves, but it's just a little bit tough sometimes with the volatility of the dividends. So those are some of the issues that we're working through to kind of smoothen out the experience and account for the fact that you could have very low income in one period, very high income in another. Is there a better experience for maybe looking at a trailing period that smoothens out those performance results? Just because it is tough with vacation rentals, but have a lot of confidence in the team. We've been internalizing more and more of the operations, internalizing more and more of the management, which is ultimately going to result in longer term better performance because we have aligned interests as Arrived and as a property management company with our investors. So really excited about that. And notably want to call out the Stranger Things house, the Byers house, which was the original house that was used in the filming for the actual Will Byers and his family, that home in Stranger Things. That thing has been occupied like crazy. So, we actually don't even have any vacant days through the end of the year. There's a lot of excitement around Stranger Things season 5. So we're working on a couple of media pieces as well that are going to be really exciting. So stay tuned for that. But we've been extremely happy with how Stranger Things, the Byers house, has been playing out. All right, private credit fund. So we have over 64 million invested in the private credit fund as of the end of September. And what's really exciting this past quarter is that we've really been able to improve the performance from kind of the 8.1% that we started out at. As our originator networks have been building up, as our supply has been increasing, we're able to improve the performance, redeploy out the cash really fast, take payoffs and get them into new loans super quickly. So that's how we've been able to improve the dividend from the 8.1 to the 8.36. So, it's a nice incremental performance, but I would also say that it's been very stable. We started off at 8.1. We've been delivering 8.1 since. We've recently been able to increase the dividend, so we've just been really happy with that performance. We have nearly 20,000 investors in that private credit fund, and we added 30 loans in Q3 into the fund. Now they vary widely in size. They're multi-million-dollar loans. They are $90,000, $100,000 loans. So we're looking all along the risk-reward spectrum for good loans, but been super happy with our credit programs. All right, so a little bit of, what are we looking forward to and what are we focused on right now within each of those investment product segments that we just went through. So within long-term rentals, which would really cover the single-family residential long-term rental individual offerings plus the fund, what we're focused on here is process improvement. As I kind of talk through our rent roll being stacked and our expirations being stacked in the late winter and early spring, that means in the fall time and early winter, we get to work very closely with our property management partners to basically kind of debrief on how all the operations are going and focus on process improvements where, our property managers and our asset management team continue to work more and more closely together. So, for example, right now, what we're really focused on is improving the renewal process, supporting our property managers with both data, labor, and just collaboration to improve the renewal rate for all of those expirations that would be happening between January to April. So that's what we're working on there. Within private credit fund, we've grown to a really large size as far as the fund goes, and we're super happy about it. That means we also need to get new originators lined up so we can have the inventory to continue to be picky. Like, we want to be super picky. We don't want to buy 100% of the inventory from an originator. We want to buy the selected 5 or 10% that we want from each one of our originators. So as we get to this $65 million size now of loans that keep turning over and over, which is good because that means we're getting paid back and collecting interest, the obligation shifts now to, all right, we got to set the staging and kind of that pipeline. It's got to be fuller, got to find more originators, got to get better products so that way we can continue to get those higher yields that we've been searching for without compromising on borrower quality or kind of the collateral value and how we look at risk reward. And then in the Seattle City Fund, we've been executing on the leasing and then layering in the additional investments. So I think it'll be, one of our more interesting asset products as we do stack multiple asset classes in there. And then, we had a commentary on, rates, right, as far as the market outlook goes. So just kind of a quick summary of what those comments were is that, here's kind of the high level that we're seeing in the market. We're seeing a coming down of rates overall. The whole curve is starting to come down, which was led by the short end of the curve. So the Fed funds rate, those, you may hear the term SOFR or the older term LIBOR, but basically those interbank rates and those short-term rates kind of set the rest of the yield curve. So borrowing costs have been coming down on the lender side. I saw that there was a question kind of about hard money rates. So, I can address that in the Q&A. But basically, we're in a period where I think that there's not a lot of volatility up or down, right? And the markets have been stable, to be honest. That's different than, are they affordable? Arguably that, some people would find those investments not affordable right now, but because it's stable, you can really start finding like some alpha in there. So we're really focused on just anticipating that mortgage rates are going to stay probably in the, high 5s to low 6s range for a bit. But with that in mind, that's also why we're participating a lot in credit as well. So you have both offerings. So on the real estate equity side, we're being very, very picky about the right areas, the right inventory supplies, because we do recognize that this will probably continue to be a challenging rate environment. But at the same time, as we allocate more of our investment capital into credit investments, we're also taking advantage of those rates. So we're kind of in a comfortable, stable spot right now with our asset thesis and the expansion into credit. So we feel well positioned to ride out the market. But these things change fast. Rates come down. We can be surprised by how fast or slow something might occur. But those are the things that we're always looking at to then very quickly adjust the strategy of what do we buy. So we can talk more about that on the outlook, but interest rates are always going to be that high level macro overlay. So with that, Jake to talk through some total returns.
Perfect. Thank you, Cam. So now we're going to talk about how all of that operational performance that Cam just went through translates into financial returns for investors. So there's two types of returns that come when you invest in real estate. There is the dividends, which is the cash flow that's generated from renting the properties out, and the appreciation, which is the change in value of the underlying investment. The dividends are always considered realized returns because it's actual cash that we're paying out into your arrived account every month, where you can reinvest that money or withdraw it to your bank account. The appreciation is unrealized because we haven't actually sold that property that you own yet and distributed those funds. And so the value of the shares that you own in any of your investments may be higher or lower than your initial investment value, but ultimately it's an estimate for right now. Now, first, we're going to go through some information on dividends. The arrived dividends are paid out monthly, so investors are able to get consistent monthly cash flow from their investments. And over the last 3 months, we distributed over $2.75 million out to investors to get to over $16.7 million paid out all time. And as a fun little spoiler alert, our upcoming November dividend will be the first time we cross $1 million a month paid out to investors. And so that is going to be a really exciting milestone. Dividends are a big benefit of investing in real estate because you're able to lock in some of the investment returns now, even while you look toward that long-term appreciation. Now, this is a chart showing the annualized dividend rate for all of the individual properties, both the long-term rentals and the vacation rentals. It's based off of just their third quarter payments. It's a good snapshot of current performance, even if it doesn't fully encapsulate all of their performance since inception. Now, remember that when you make an investment in one of those individual properties, you earn the dividends and appreciation based off of just that specific property. So if you invest in only one property, you might have one of the really high performers, but you also may have one that ends up having an issue with a high expense or a tenant that doesn't pay the rent. So rather than having all of your eggs in one basket, it can be more effective to invest in a number of different individual properties in order to spread out that risk. Now, this is the same chart, but I've overlaid the private credit funds dividend yield and the single family funds credit dividend yield. Now, unlike those individual properties, the funds dividends have tended to be stable over time. And that's because those investments in the funds are diversified across all sorts of underlying assets. Our single family residential fund has over 50 properties in it. And so, if there are a couple of properties in the fund that aren't rented, it doesn't have a material impact on the overall cash flow that fund is generating. And that's kind of why the single family residential fund has been able to pay out a consistent 4% dividend every month since it launched. The private credit fund is super similar since it's a big collection of different real estate loans. That fund, as Cam talked about, paid about a consistent 8% dividend, and it's actually ticked up a smidge recently since it launched about 18 months ago. Now, that dividend for the private credit fund is about twice that of the single family residential fund. But the key to remember here is that the private credit fund doesn't really have the expectation of appreciation in the way that the single family fund does. That private credit fund is really angled on earning higher cash yields now, but there is little expectation of appreciation in the future. Now we're going to combine the dividends and appreciation to look at the total returns for each asset type this quarter. And I'm going to highlight a few things on this table. Now, the individual single-family properties had an average dividend of 4% per year. And that's a simple average across all of the properties that paid 3 dividends in the past quarter. It's a mix of recent properties and older ones and includes all markets. The average appreciation change for those properties was down 1.4% over the last 4 months. Now, we'll see again that the single-family residential fund had an annualized dividend of 4.2%, virtually the same as the overall average for the individual single-family properties. Our acquisition targets for the fund is basically the same as that for the individual properties, and so it makes sense that the collection of properties in the fund has the same dividend as the aggregated group of individual homes. Again, here we see the private credit fund at over 8% annualized dividend. And again, while that's higher than the single family investments, keep in mind that there is no expectation of appreciation with that fund. Whereas the single family investments will likely end up being about half dividends and half appreciation over the long-term returns. Now, we don't have the Seattle City Fund on here, but Cam mentioned that it is fully occupied and we're gearing up to start paying out its first dividend soon. Hit the slide load. There we go. So now we're going to take a quick look at the total gross returns since IPO. So this is combining the dividends and the appreciation returns for all of the individual properties only. And this is not annualized. So the properties that have been owned for a longer period of time, to the right side of that chart, have had more time to appreciate and they've paid out more dividend payments. The properties that are on the left side here, have only paid out a handful of dividends so far, and they haven't started to get their first arrived valuation update. Now, you can see that, as time goes on, the typical gross return for properties tends to increase, as well as kind of the dispersion of potential outcomes, again, leading to a plug on diversifying into a number of those individual homes. Now, I said earlier that the appreciation returns that come from those arrived valuation updates that you see in your portfolio are all unrealized returns. And I want to talk a little bit about the two ways in which those unrealized returns actually become realized. The first way is when Arrived sells a property. When this happens, we take the sales proceeds from selling that home after all of the expenses, and we distribute it out to investors proportionally by how many shares you own in that particular property. Then we wind down the LLC, and that signifies the end of the investment. We sold one property so far, the Centennial in the Charlotte area. We sold that one last fall, and investors ended up earning a 20% appreciation gain over the 3 years since they bought that property. We may start to look to sell other properties as they started to age into that 4 or 5 year old age range. The second way that appreciation becomes realized is if investors sell their shares to other investors on our new secondary market. When this happens, the investor selling their shares realizes the appreciation from their initial investment to whatever price that a buyer was willing to pay for those shares on the market. Then Arrive continues to operate the property with future dividends now going to the new investor who's bought the shares of that property. The secondary market just launched for the first time in August, and we've seen incredible traction so far, with over 57,000 buy and sell orders being placed across 300 properties across only 3 different trading weeks. We've been rolling out the secondary market with different batches of properties eligible each time. And starting next Friday, the market will open for the last time this year with 108 properties eligible to trade. Then we'll be announcing the 2026 trading window dates. On the secondary market, you're able to sell shares that you currently own, and you've got the ability to buy shares from other investors. This essentially opens up the back catalog of Arrive properties. You're able to add shares in properties that you may have missed. This could be different markets, vacation rentals, properties with leverage, and more. And there's a preview phase of the secondary market available now. So you can actually go to the site and check out all of the properties that are going to be trading next week. If you've been curious about the secondary market, I highly encourage just poking around and checking it out, even if you aren't interested in placing orders right now. And with that, I'm going to pass it off to Ryan to talk about what's new at Arrived.
All right. Hi, everyone. Thanks, Jake, and thanks, Cameron. So I want to kick off and just chat through a couple of the new things that we've brought to Arrived in the last quarter, and then we can jump into Q&A. So feel free to keep threading questions. We've been tagging those as we go, and we'll address those live here in a moment. And just kind of following the thread that Jake was chatting about on the launch of our secondary market, between the first few trading weeks, we've now done 3 trading weeks on the secondary market. We've been shipping a lot of new product iterations for investors based on feedback. So we've added new filters so that investors can find specific properties that match certain search criteria that they're looking for investments that they might be wanting to buy into. We added historical charts to display monthly dividend yields and price trends for each property so that investors can see how those properties have performed over a longer period of time on a graph instead of just seeing the most recent update. And then we've also added some more investor education around the secondary market and how that works. So we're really excited about the first few weeks of trading and the level of engagement that we've seen from investors now that we have this great way for investors to buy and sell shares from each other on the platform. The other thing that we added is we've updated our historical returns page. So we've tried to make it easier for investors to review performance across the Arrived portfolio. We also have the performance on each individual offering as well. So investors can browse the current performance of a specific property. They can see on an individual property, the property history timeline, and then within our funds products, the financial performance as a tab on the offering page. But this was meant more as a summary view to be able to see the performance across the Arrived portfolio overall. And we've also been tracking the performance of the total Arrived portfolio since inception against public market comps, like the Vanguard Real Estate ETF or VNQ. And we've seen that we've demonstrated really strong performance compared to Vanguard's real estate ETF since the inception of Arrived, roughly returning 30% or greater over that time period. I think really just highlighting, the difference of more directly owning and investing in real estate versus some of the public market alternatives that tend to be more volatile and also trade based on other market characteristics beyond just the fundamental performance of the underlying real estate. And then the last thing I'll speak to is we launched a new dividend performance dashboard, really designed to give investors greater visibility into their dividends, particularly valuable for investors who have widely diversified portfolios with many properties in their portfolio, and being able to see more detail alongside that. And we also now have a sortable dividend detail view for your investments as well. So those are a few of the quick things that we've added in the last quarter, and a lot of focus on really the launch of the secondary market. We also always love feedback from investors on things that you're liking, things that you'd like to see more of, or things that we could improve. So please feel free to reach out if there's anything you think we should be focused on. And with that, I think I'll invite a few folks back to join me, and we can jump into Q&A.
Fantastic. Ryan, Cameron, and Jake, thanks so much for prepared remarks. Jake will be in the chat, either answering questions or teeing them up, so keep them coming our way. We will be hyper-focused on questions that are related to performance today, so if it's more one-on-one, we will direct some resources in chat. But we'll go ahead and get started. Ryan, we had a theme about what could be coming next, so I'm going to move with those first and then go through the queue. Is Arrived establishing city funds beyond Seattle? Vic had asked this, and I believe there was somebody else in the chat. Luke was curious as well.
Yeah, so we do have plans to expand the city fund format to new cities as well. Right now, we're focused on, as Cameron mentioned, we were getting the Seattle fund stabilized, now 100% occupied, and we've also added some regional credit to the fund, and we're evaluating potentially some small format multifamily properties in some great areas of Seattle as well. We've surveyed investors to see what cities that they would be interested in seeing and what characteristics of cities. Are they more interested in focusing on cities that could bring a higher potential for yield or may have a higher potential for appreciation? So we'd love to hear from investors if you're interested in investing in or diversifying into more cities, and if so, what cities would be top of mind.
Fantastic. Awesome. Yeah. Echoing Ryan, please share in chat what cities you would like to see. We'd absolutely love to hear from you. We're hyper-focused on building for and by investors, so keep the feedback coming our way. On that theme, Cameron, I'm going to kick this one to you from Betty. Are there any plans for properties in Indianapolis or Boise, Idaho?
Yeah, definitely. So Indianapolis is a market that we currently invest in. I can say that we currently do have properties in the pipeline that are under contract in Indianapolis. So, be on the lookout for those if you're particularly interested in that market. And I would say Indianapolis is one of our conviction plays in the Midwest. Like, we really like some of those areas in Ohio, Cincinnati, Columbus, Indianapolis, where there's a lot of good core economic activity there related to pharmaceuticals. Agriculture is really strong. They're going to continue to be strong. So we really like that area, and it's still affordable. And on a non-related note, I'm a Hoosier, and I met my wife there. So I have particularly fond, I like Indianapolis. Boise, we also like, and it's a hot market. I think it's more of a timing issue. Boise had a huge run up over the last 10 to 15 years, and I think it'll continue to have net population inflow. But I would say that right now we're still a little bit overheated. Market needs to correct a little bit. Fundamentals are there, more of a timing issue. So I would look out for when we do expand there, and we got, again, we have to find the right investment entry point. It could be through credit, it could be through multifamily, it could be through ground up development. But every region is going to have their own specific one, and specifically for the SFR rental model, it's a little bit too expensive right now, but we do have our eyes on it. We do underwrite it. It's a market that our team's familiar with, as a lot of us came from American Homes for Rent, who had active operations, large operations actually, in both Boise and Indianapolis. So markets we feel comfortable with, timing issues.
Fantastic. I see some more questions around what could be coming. So we'll jump to those in a little bit. I know we have some heavy hitters in here. A good one from Thomas. Cameron, you briefly touched on this in prepared remarks, but how much will Fed rate cuts affect, if at all, the rate charged for hard money in the private credit fund? It's a great question.
Yeah. So the first degree answer, I would say, is not that much. What those hard money loan rates really are influenced more by are the supply and demand for that credit. So from a first degree connection throughout the whole, like last 15-year cycle, there hasn't been too much volatility on the borrower rates, despite Fed funds rate going from 0 to 5 back down to 3. Like, it's been a roller coaster on the short end of the curve, but the rates for the borrowers stay fairly stable because it's like really based on the market of originators, the capital they have, and then the demand for those types of loans. I will say that the second order effect, though, of where this does start impacting rates is the availability of credit. So as rates come down on the short end of the curve, the warehouse facilities, which is basically a lender's warehouse facility. So if you're an originator in the business of issuing loans, you may not have all of the capital in the moment to be able to fund the loan on closing day. So you would have a warehouse lender or what's called a repo facility to leverage those loans to be able to fund it. So those are very much indexed to the short-term rates of capital plus some spread. So as those come down, capital becomes more available. So you may have more dollars chasing the same number of projects. So from that perspective, over a longer period of time, that could put downward pressure on borrower rates. We haven't seen them quite flow in yet, but I do believe as a second order effect, that gets priced in over time. So if that trend continues, more capital becomes available, more supply of money. Let's assume similar number of projects, you would naturally see it kind of inch down a little bit. So the range may be small by which it inches down, but I do believe that it does have that secondary order effect, but not a direct effect like, oh, just because those rates go down all of a sudden means hard money loans go down by the same amount of rate. It's an indirect relationship through availability of capital.
Fantastic. Awesome. Cameron, I would take your commentary over a crystal ball any day to see the future. So very much appreciate you walking through it. We're going to jump into some more performance related questions here. A good one from Gerald in regards to the private credit fund. Have you encountered any late payments or defaults for the private credit fund? Ryan, I'll kick it to you, and then Cameron, if you have commentary as well.
Sure. Yeah. So, starting at the high level first, we haven't had any, foreclosures or credit loss within the private credit funds or our credit product lines yet. And we've had over 100 completed projects today. I think we've had over $100 million invested through various credit products as well. We have had from time to time late payments, I think a handful, maybe 2, if I'm remembering correctly so far. In those scenarios, we earn an elevated rate of interest during that late payment cycle. And typically it might be that, the developer is looking to extend the project. They might even be looking to, refinance the debt if the project's taking longer than they expected. And so they want more, time to complete the project before they go to exit the property. And so those all seem to be, normal course and supporting, developers in that fashion. So that's the current state. And Cameron, maybe if you want to speak to some of our partners there, a big part of our evaluation process is, finding partners that have had historically incredibly low rates of credit loss. But Cam, anything else you'd add?
Yeah. So that's a great point about the default rate of the originators, because as we do onboard them, we look to make sure that they have responsible lending practices. So kind of the order of operations as we're deploying credit goes: vet the originator, vet the borrower, vet the project, kind of in that order, right? So a lot of the times when you have loans that do have late payments, it's not that it's like heading towards default, but rather there's like a cash gap that a borrower may need to bridge or something like that. So we've had a lot of confidence in our originators as we ask for their historical default rates. They usually tend to be between 0 to 6 or 10 basis points, which means 0.1%, right? Like on the principal loss part of it. And that's across their whole portfolio. And if we go back to the comments earlier about how we onboard originators and shop a certain percentage of that and stratify that, we feel good about the quality. The other thing I'll say about the underwriting process is really to be cognizant of the loan to value ratios as you're looking at the credit investments, because you got to imagine, like, as a lender, it's a bit of a different exercise to say, what's my worst case scenario? So you underwrite to the downside, and as we look at those lenders, we make sure that they have good loan to value policies such that if they're increasing in the risk of the type of property, let's say it's something fairly illiquid, maybe a $10 million project, that can shrink in value pretty quickly. So you wouldn't want the same loan to value ratio on that as you might like a very liquid $300,000 property in big suburb metropolitan. That's a highly liquid property. It's probably not going to take much of a discount at all. So you might be willing to take lend a little bit more on that one. And then, similarly, you got a $10 million loan, your LTV better be really low on that, to responsibly purchase that, which is the way that we look at risk mitigation. And, so even in worst case scenario, if it were to go through default, if you were to process it, file the foreclosure, go to auction, what we're making sure is that even with a big liquidity discount, even with a big foreclosure, discount, are we still going to get paid back, reasonably so, with all the elevated interest and fees? And if we feel good about that and the borrower, then we'll commit to that. So, have a lot of confidence in the loan portfolio, but late payments are a natural part of the lending and portfolio management process.
Fantastic. Thank you both for walking through it. Great question there, Gerald. I did drop a link to an FAQ too with more details if you'd like to take a peek. All right, jumping into more performance-related questions. A good one from Peji. Great to see you here today. Why have individual long-term rentals experienced a 1.4% drop in appreciation in Q3 compared to 0.2% increase in the single-family residential fund? The difference is too high. Would love more insights here.
Yeah, definitely. It does feel high. So hopefully I can give you a couple mechanical things that shape the context around it. So I think that one of the first ones that comes to mind is timing bias. So there were a fair number of properties kind of at the apex of 2022 where those markets were more overheated. So like Nashville was a bit overheated, Atlanta was a bit overheated. So we backed off some of those markets in the recent years. Again, not really a fundamental change in the conviction long-term of it, but it's all about timing and getting in on the right buy. So some of the properties in 22 and the markets that we had expanded to are ones that probably got a little bit overheated during that COVID time. And then now they continue to revert to the mean a little bit more. Whereas the fund was started in, November of 2023. So, over a full year and a half had passed from that like apex point in the market to when we started contributing properties into the fund. There's also a higher concentration of Tennessee and Arkansas in the fund, which has, from our perspective, outperformed a lot of the rest of the country in that time period. So like I totally agree with the observation mechanically, like how that feels magnitudinally a little bit large. It also comes down to sample sizes too, because 56 properties, while it does represent a nice diversified slice of like our investment thesis, that's probably small enough to be materially swung such that delta can exist between 1.4 and 0.2. So like the markets, the price points we were purchasing at, the fact that that some of those prices in 2022, we're buying $550,000 assets. So those are getting like hurt more because of the financing side of it, making the payment too high. So we've seen a little bit of reversion of that. Whereas once rates did get to the levels they're at now, we readjusted our purchase price points down to like 270K, 280K on average. So, the basis, the geographies, and the times are probably what are contributing most materially to that difference. Because a lot of our portfolio, is 2021, 2022, and then all of the portfolio for SFR fund is back half of 2023 and further. So I think it's those two factors that are most heavily contributing to that disparity.
Fantastic. And then switching gears a little bit here, Cameron, to vacation rental performance. Daniel had said they would love some commentary. They've seen the dividends decrease, so they'd like to understand if you have any more details there, and perhaps if we have a plan in the future. And then Ryan, if you have color there as well, too.
Yeah. So on the operational performance side, I think that we're kind of at a moment in time where there's a difference between like a lot of the great things that I'm seeing on the operational side in terms of the infrastructure we're building, we're bringing a lot of the properties that were third-party managed back in-house. So we've seen really good initial results from the performance, good reviews, strong monetization, accurate pricing, like just good all the things that you want to see. But I think there's two things contributing to like the mismatch in expectations against the dividend. One, we're just in a transitional process. As you take properties back from property managers, you kind of, in one sense, you start over from a reputational perspective, like as an Airbnb listing or VRBO listing. So you kind of got to build up that social, experience again. So that I would say has been one of the major volatile points, despite like improving operations, is that there's just been downtime on those properties. The other is that we're paying out dividends based on the actual monthly performance, but what I think we're realizing is that that's a very choppy experience for investors when it comes to like the expectations and that stability, because it can range from negative income in 1 month because you're just paying expenses and like nobody's visiting the market to 20% of your income coming in 1 month. So just that whole, how far do we look back to average out the experience if the choppiness of like high and low it has not been ideal for investors or causes like questions about like how the program is going? That's the other angle of like what we're looking at. So operational transitions, but like intense seasonality has been contributing to like the main driver of those things.
Fantastic. Awesome. Let us know, folks, if there's any other questions in regards to performance there. Happy to jump back through them. I do see some more questions around what we could have in the future. So I'm going to pop this one in the queue. A good one from Ken. Is there any consideration to shortening the period that an investor will need to pay redemption costs for either of the credit funds? 5 years is a long time. Ryan, I'll kick that one to you.
Yeah, it's a great question. I think, to start, if you're making an investment decision into one of our funds, you should do so based on the current redemption program that's in place. But to answer the question directly, yeah, this is something that we're looking into now and excited to keep iterating on for investors in the future. So keep an eye out. But as a reminder, please use the current redemption program to inform your current investment decisions.
Absolutely. Great feedback and more to come. If folks are curious on the redemption program as a whole, it's on the offering page as well. So feedback. All right. A good one from Gerald. Do you have any internal policies in place for credit fund with regard to borrower concentration or geographic concentration? For instance, no single borrower may constitute more than 5% of the portfolio. Cameron, I will kick that over to you.
Yeah, sounds good. So in our offering documents, we have a outline of just like the general investment criteria, as well as like what the core of the thesis is and where there are some limits on loan to value ratios and things of that sort. In terms of concentration limits, we took a bit of a different approach just because we're trying to handle the kind of volatility of building a portfolio and building up an evergreen fund and not exactly knowing what is going to be the inflow of funds, what is going to be the need, like loans that we come across, and like having that matching exercise. As you get larger and larger and larger, it becomes easier to codify that in Word to say, here's our policy, concentration limit on this borrower, this geography, etc. We didn't want to limit ourselves in that like codified way because of that kind of like uncertainty on how to match the flow of the investment coming in with the opportunities that we had available to us. But if it's not codified, then what do we do? In kind of lieu of that, like real explicit policy, we have an investment committee that is comprised of the senior leaders within Arrive that meets on a weekly basis currently. And we're reviewing the loan opportunities, we're reviewing the policies of the fund, the flows. So it's very actively managed in that sense and in all aspects. But concentration limits is not something that is explicitly codified in the investment offering.
Fantastic. Awesome. I'm seeing some great product feedback in the chat too, so keep it coming. I know Daniel mentioned a new feature request, a single family property history feed for all properties I own with filters for event types, excluding dividends. Jake mentioned we're working on that, so keep it all coming in the queue. This is the best place to share your feedback. All right, moving back over here. Javier, and I believe there was another person in chat too. Any plans for buying apartments in big cities? I know there was a question about multifamily too. Cameron, I'll kick to you.
Yeah, so I think that multifamily in general is very much in the aperture of what we're looking at. The size of it, it's going to depend on the model, because you could do, say, a value add flip, call it a 2-year project, where you're kind of repositioning the value proposition of that apartment building. Maybe you're making some improvements, letting leases expire, but trying to get more cash flow out of it. The other model could be more of a buy and hold. So we're, maybe there's a good deal on an apartment building, and we believe cap rates are going to compress further and further lower, increasing the value of the building. And that would be a different strategy. I think on top of that, we have to consider the size of the arrived investor base relative to the size of the project, and make sure that there's a good match. There's probably a lot of good multifamily with some favorable leverage that we could find in the $2 to $5 million range. And you can get a reasonable block. Buying a $50 million apartment building on a New York City block, I could see that as like a future investment product. That's probably a mismatch today with where we're at, but it's not because of the investment thesis necessarily, as much as like your thesis plus the opportunities plus the investor like matching, the sizing matching, they all have to align. So I could see us getting there, but right now it's probably not the right product fit for the investor base that we have.
Fantastic. All right. A couple quick ones in here. Cameron, any property sales in the works right now? Peter was asking.
Yeah, so we're looking at our leverage program and some of the properties that we have. And as some of the fixed rate interest only periods are coming due, we are deciding on like the exit plan for those, and whether they'll could stay internal and refi, or find some solution to keep it on platform. We could take an opportunistic, like take some gains off the table. So there are some in the works, and we're orienting the program around those with loans that we want to optimize. But yeah, the property sales are in the works for those.
Fantastic. Awesome. We've sold one property to date. The Centennial was around October of last year. I believe Jake chatted a little bit about that earlier. But when that takes place, for folks that haven't gone through that process yet, we update that property performance tab so you can follow the whole sale just like you would if it was your rental property. All right, moving back over here. Good one from Gerald. Cameron, you had mentioned warehouse lender, which sounds like a senior creditor ahead of Arrive investors. They thought that the credit fund was completely unlevered, investor equity only. Is that not the case?
Yeah, so the warehouse lender mechanics, let me quickly go through that. So it was more speaking to how an originator kind of works, and it was I was answering the question kind of about the rates, right? And where is there pressure on rates to go up and down? So from an originator's perspective, their business requires that they have the capital to actually lend on the closing day, and a lot of originators do not have that huge cash position on their balance sheets. So they have a warehouse lender that helps them originate the loan, and as soon as that originator makes that loan, that originator is the lender, so they're entitled to the interest, but they also have a lender, so they're paying their warehouse lender while it's on their books. Okay, so all of this is pre-Arrived, right? Arrived is not in the picture yet. They just originated a loan. Now, Arrived comes to the table and says, hey, that looks like a great loan. We'd love it in our portfolio. Can we buy it off of you? And they say yes. So when you make the loan sale transaction, that gets rid of the loan on their books, because that loan that warehouse lender has is against the originator's loan. But once they sell it, Arrived wires the money for the transaction amount, and then the lender gets paid off, and we're first on title now. So the warehouse lender is really to facilitate the originator operations. But once the originator has an exit with a capital partner like Arrive to purchase the loan, we're not inheriting that, or not competing with that warehouse lender's loan to kind of originate the fund. So we are in first position on that.
Fantastic. And then following that, Jim had a great one. Can you explain hard money to us? When I first heard the term, I thought it was a loan secured by, yes, if you could walk through that, Cameron, would be great.
Yeah. So the term hard money kind of has its roots in the fact that the loan was based on the value of the collateral, not the credit worthiness of the individual. So the thought process was like, well, if you don't have great credit, you have this awesome asset that I know is, securing my loan. So I'll still lend you money. And, that could be some, very like localized lending, small time lending, where you might have situations of unscrupulous lenders who, kind of take advantage of the situation. I think that's kind of an older portrayal of the way that real estate market had worked. But, it does have its roots in that, it would have been private credit. It's, kind of entrepreneur to entrepreneur loan. So it wasn't like a highly regulated or institutionalized segment of the market. But in the last 20 years, there's really been kind of a revolution and renaissance of real estate capital markets, and included in that is kind of the elevation of hard money lending to more of a private credit residential transition loan branding of this segment, which is largely driven by the credit. But the hard money thing is kind of a misnomer in that we look at credit. We pull FICOs, like the originators, they pull FICOs. We look at their statement of kind of the wealth that they have to secure the loan, their liquid reserves. So there's a lot of underwriting that goes into the borrower from these originators, but the root of the industry is kind of that like unscrupulous, kind of shady area where it got the name hard money loans, and it doesn't really have a great connotation to begin with. But the residential transition loan, the fix and flip market, it has become that, but it's also been elevated with requirements, due diligence, a lot of institutional formalization. So it's a very much more mature market than it used to be, and still good risk reward, but it's shed off a lot of the like bad connotation, bad reputation that it had in the past with that name.
Fantastic. Awesome. Thank you both for walking through all the details there and questions. I think we cruised through all of them that came through the queue. Please keep me honest in chat. I know we're getting close to shutting our virtual doors here. But Ryan, maybe we talk about what you're most excited for as we're almost into 2026 here. So for the rest of Q4, 2026 and beyond.
Yeah, no, it's one, I'll just say thank you for everyone who took the time to jump on and to join us for the quarterly review. And Cameron and Korin, thanks for helping lead the Q&A, and Jake for helping run through a lot of the updates. Yeah, it's been exciting, an exciting close to the quarter with now having liquidity options across all products on the platform, and we have a lot of exciting things in store over the next year and a lot of growth that we have planned ahead. Really, the team is just very focused on, identifying investment opportunities that we believe in and are excited about and putting in front of investors, both on the equity side and on the credit side that we've been developing more and more over the last few years. So yeah, really excited for what we've got planned for the rest of the year and into next year, and then more of these quarterly updates to come.
Absolutely. Yes. So appreciate everybody today. Cameron, any closing remarks on your side before we shut our virtual doors?
Just want to echo Ryan's appreciation for everybody in attendance today and all the hard work that goes into producing these results and these webinars. And then really excited just about the future of the investments that we're bringing on here. We're going to continue to expand credit. We're increasing our originators. We're increasing the level of kind of sophistication we're implementing to try to drive better returns and lower risk for investors. So I'm super excited about credit. And I think that there's some things on the equity side that we're working on that will really facilitate maybe even some whole home transactions, some tax advantage transactions that our investor base is telling us that they've been wanting solutions for. So a lot of cool things we're working on in the background, expanding credit, but just getting better at everything that we do every day.
Absolutely. Well, Ryan and Cameron, thank you so much for your time and prepared remarks, for walking through the diversity of questions. For all the folks in chat that spent 56 minutes with us on your Thursday morning and afternoon, thank you. We so appreciate the engagement, you taking the time to ask such fantastic questions and choose to spend time with the Arrive team. And a huge kudos to our Arrive team who are in the chat and also doing all the work behind the scenes. I know you see a few of us on webinars and other places. We have a whole host of folks that work hard behind the scenes. So thank you. Thank you. Hope you all have a great rest of your day and happy investing.
Thank you.